Assalamu alaikum, ladies and gentlemen. This is the first presentation of a series of presentations on Basel regulations. And Basel regulations, as we all know, forms the key crux and the backbone of all the various regulations which currently the bank follow globally. They are globally accepted. So the purpose of this first series, which I'm made on Basel I, is to highlight how and why the regulations came around and the various specifications of Basel I. Why I'm starting from Basel 1, though we are on almost on Basel 4 this time, is because for us to understand Basel 2 and 3 and 4 better, we need to understand the evolution and the entire journey which the Basel took. So hence because one builds on the other. Currently, the banks are grappling between Basel 2 and Basel 3. Basel 2 has to be fully implemented by all the banks globally. So hence to understand the other stages, you have to understand the basics for which is Basel 1. So first of all, how did evolution of Basel Accords, how and why were these standards thought necessary? So to start with, these Basel regulations came, as you can see, in April 1988, but they were certain, and then in 2004 we had the Basel II. After post the global financial crisis 2007 2011 we have the Basel III, and now we have the Basel IV. And let's zoom into each of them one by one. First of all, the events leading to Basel I. What were those events that led to Basel I being Basel I? So during 70s and 80s, there was a lot of cross currency and cross countries lending taking place, and in we had some major oil shocks in 1973. So in 1974, you had this first major bank. It's the name is Bank Herstatt. It's a German bank that collapsed due to the settlement risk, the third party risk, wherein the currency they gave the Duce marks but did not get the US dollars. So it was one of the first biggest bank collapse that took place. This was followed by another bank in America, Franklin National Bank. It was among the 20th largest bank, and it led because of currency speculations. Then in 1982, sovereign defaults took place. Mexico, Argentina, Brazil, they all defaulted on their for sovereign payments. So as a result, there was a need felt as to have her, and because of their defaulting, the banks defaulting, the sovereign defaulting, the ripple effects all over the world. So hence the need was felt that we should have some form of a uniform standard whereby we should all get together and ensure that this does not happen again. So in 1988 of July, central bank governors of 10 countries, which was a G10, which includes United States, United Kingdom, Germany, France, at that time uh, Belgium, Netherlands, uh, UK, USA, and now they all got together in Switzerland, Basel, and they formed this company, this organization of Banking Committee on Banking Supervision. This was formed in 1974, but then post all these events, they all gathered, and on 1988 July, Basel One came into being. And as I said, the evolution was of bank failures, which we discussed the two major banks, Hersert and Franklin Bank, then rapid lending, the era of massive lending that took place among corporates and across country, cross functional that took place. The rules, they were not uniform rules. Some countries have very lax rules, some countries have stricter rules. The traders would arbitrage, and then sovereign defaults, Argentina, Mexico defaulting, which all necessitated all that. Then coming to zooming into Basel I, the accord itself, what is it? As I said earlier, it is the first agreed framework that sets minimum capital requirements for internationally active banks. Minimum capital requirements for internationally active banks. Again, it was published by the Basel Committee on Banking Supervision in by July 1988, and a common language for the banks, safety requiring bank to hold a certain capital with respect to the risk weighted assets. We'll come to this in the coming slide. So as I said, banks in this, what the banks were required to do, the banks were required to have a capital adequacy ratio, which was primarily based on the assets and the type of assets. It was supposed to have certain percentages of those assets allocated to allocated assets capital. Okay, let me explain this further. For example, for example, you had a loan given to a corporate. As per the risk weighted asset of that shown in the slide, that corporate supposed to have 100% of its you give $100 million to a corporate, that would be counted as total as 100% of a risk weighted assets. 100 million is a risk weighted asset against which you're supposed to keep 8% as the capital. So $8 million will be the capital. Similarly, the corporate loan and the corporate loans given 100%, 50% to residential mortgages. For example, you give $100 million as residential mortgage to some company, to some obligor, but it would be only a 50% because you already have a residential mortgage as a security. So instead of 100, you will count it as 100 into 50%, that is 50. 50 would be your risk weighted assets, of which you will keep 8%. 8% into 50, which is 4 million dollars will keep as the capital. Similarly, for interbank claims on OECD Bank, Organization for Economic Cooperation and Development, now there are 38 countries. If one bank of a OECD country, and most of them are G7, G10, G20 countries, US, UK, Japan, Germany. So if they were to if their banks were to lend to each other, it would be considered 20%. For example, you lend a bank in United States, give to a bank in UK $100 million, you will keep 20% as risk weighted asset. That will be considered as 20% risk weighted asset. That will be 20% into 100, that's $20 million, of which you will keep 8%, that is 1.6%, $1.6 million as the capital. And cash on hand and OECD government bonds, it's 0%. Like they are not risky, considered risky at all. I will explain this further, delving into this further. When you say I've told you about the risk weighted assets of, and then now let's talk about the regulatory capital. As I said, for Basel I, you're supposed to keep 8% of your risk weighted asset as the capital. That is your risk weighted, your capital divided by the risk weighted asset should be 8%. So what is the regulatory capital that we are talking about? So regulatory capital is divided into two parts. First is the core capital, the other is the supplementary capital. Now what is the core capital? The core capital, this is the paid in equity, which is the common shares. It could be the disclosed reserves, which are the retained earnings, which are the statutory reserves, and which are the share premiums which are disclosed on the balance sheet. Basically, this is the core equity. Core equity. Supplementary capital are the subordinated debt. It could be the general provisions. It could be any sum of a reserve. So the first, if your bank has a loss, the first loss absorbent is the core capital. That core capital absorbs the loss. This is followed by the supplementary capital, and then the supplementary capital absorbs the remaining loss. So this is what you are supposed to keep 8% of the risk weighted asset in this form. But another catch, and the catch is that 50% of your capital should be the core capital. Now, primarily, Basel I dealt with credit risk, primarily, but it had some guidance given with respect to the derivative exposure. For the derivative exposure, it was very simple. You convert it to what they call a credit equivalent amount, and then you apply the risk weight, what we spoke about, 100%, 50%, 20%, 0%, based on the counterparty. Now, to convert to credit equivalent amount, there are two methods. One is the current exposure method, the other is the original exposure method. Current exposure method, CEM; original exposure method, OEM. Now let's see them one by one. First is the original exposure method. The original exposure method, again, it was a very simplified way, basically based on the type and the duration. The type and the duration of the contract, a fixed percentage was applied to the notional amount. For example, like you had basically the interest rates contract and the FX contracts. They were the only two type of contract which the Basel I treated the derivative exposure. No equity exposure, no other commodity contracts, but just the interest rate contracts and the FX contracts. And that too, for the 1 year, you apply a factor of 0.5% for 1 to 5 years, 1% for greater than 5 years, 3% for less than 1 year, 2% for FX contract 1 to 5 years is 5%, and 7.5% is greater than 5 years. Now, what happens is that you just, for example, if you have a 3 year FX forward contract of 10 million, since it's 3 years, it comes into this bucket, it's FX contract, so it comes over here. You just apply 5% to your 10 million, which is the credit equivalent amount, which becomes $500,000, right? And then you see what type of corporate it is. Is it given to a corporate? Is it given to a corporate? Then you apply 100% as the RWA. That's all the half 0.5 million as RWA. If it goes to a mortgage residential loan related to a mortgage residential loan, then you apply 50%. So it's that. Then comes the current exposure method, which is considered to be far more accurate. As this method, you calculate the mark to market value, and then you have a add in percentage of the notional amount, again depending on the type of contract and the tenor that is there. Type of contract would be the interest rate and the FX contract, which were the two covered by it, and the tenor would be less than 1 year, 1 to 5 years, greater than 5 years. And then you had the various percentage applied. Now let's understand with an example. For example, you have a 3 year FX forward of 10 million with a mark to market of 0.3 million. So in that case, the credit equivalent amount would be 0.3 million, which is the mark to mark, plus 5%, which is given by, because it's a 3 years, so 3 years come into 1 to 5 buckets, the FX contracts over here. So 5% you apply to the notional amount, which is 10 million. So 0.3 is the mark to market, plus half a million, which is 5% into 10 million, is 0.8 million. Now let's compare these two methods, treatment of the FX exposure. So once you have got to this credit equivalent amount, then you apply the weights as a OECD government 0%, OECD bank 20%, which we spoke about in the earlier slide, to come up. For example, if the 100 is a corporate exposure, the RW is 100% of the 800K. If you have calculated the credit equivalent amount is 800.8 million dollars, then you apply the whole of it goes to the as a treated as a risk-weighted assets, and 8% of that is kept as a capital. I will repeat. For example, if it's a corporate exposure to which the credit equivalent amount works out to $800,000, of which you will take 100% as the RWA, which is again $800,000, and then you will apply the 8%, which is 64K, you will keep as capital aside. Now let's compare these two methods and see how do they stack up. First of all, as you say, in the original contract method, there is no mark to market, and hence it's very simple. You just apply based on the type of contract and the number of bucket it falls, you apply the percentage. So accordingly, since it's just an arbitrary value, it's low accuracy in exposure. There's no mark to market, no volatility because there's no mark to mark taken. So there's no volatility exposure taken, and because of all this, it could under or overestimate the capital. You could either over gauge your risk or under calculate your risk. On the other hand, the current market exposure, because it factors into account the mark to market, so it requires modern system requirement, because you have to calculate the mark to market. You need to have the ecosystem, the systems in place to calculate them. Medium accuracy in exposure, yes, because mark to market is factored into account, so yes, its accuracy is better. Indirectly, volatility consideration, yes, because you introduce the concept of mark to market, which means you will factor into account how much is that contract or FX contract right now. So that is why you and mark to market could change depending on the changes in the economic environment, and that is why there's an indirect volatility consideration as well. And then it's realistic capital requirements. Why? Because since it's better accurate, more accurate measure than original equipment exposure method. Therefore, it has better and realistic capital exposure requirements compared to original exposure method, which could over and under calculated. Now, all this was going on till 1996 when further issues took place and they realized the limitations of Basel exposures. I mean, the Basel regulations. And so, what was those? So, certain amendment in 1996 were introduced. So, what were those amendments? So let's talk. In 1996, amendments to Capital Accord introduced a capital charge for market risk, the risk of losses from movements in market. So primarily Basel I dealt with credit risk and very little, slightly with some derivative exposure. But certain events like the Barring Bank collapse in 1995 because of rogue trader and Orange County bankruptcy, interest rate risk showed that this was not complete and they need more need to be done. As a result of which, the amendments. So, what did the 1996 amendment require? The amendment required that banks hold capital for market risk as well, and just a simple capital charge, a percentage on the capital charge market equivalent of the assets in the trading book were kept. A 8% capital charge on the market risk equivalent value of the assets in the trading book was kept. So, what were the market risk categories? Interest rate risk, equity position risk, foreign exchange risk, commodity risk. Interest rate risk, equity position risk, foreign exchange risk, and commodity risk. They were the market risks that were factored into that that approach. And then accordingly, because there were two approaches to calculate the such exposures. One was the standardized approach. The other was the internal. The other was the internal models approach. So let's take and understand them one by one. In a standardized approach, there was just a general risk, market-wide movements, and then a specific risk, which is issuer default risk. We will see this with an example: market-wide risk, and then issuer-specific risk for the standardized approach. Example, government bond with a 5-year duration would attract a specific charge, capital charge, plus a duration based general charge. Now let's see how this works out. In equity risk, you have general risk 8% of market value and specific risk 4 to 8% depending on issuer. We will understand this in an example. Foreign exchange risk, it was a very simple method. It's capital charge 8% of the net open exposure. Commodity risk is 15% of the net open position, accounting for the spread and basis risk. Okay, let me repeat. In a standardized approach, for the 1996 amendment of Basel, you had a general concept was you had a general risk with a market-wise exposure plus a issuer-specific risk. You for the market you kept a certain portion, fixed charge, plus for the company specific or issuer specific risk. And the three type of risk that were deal with: equity risk, financial FX risk, and commodity risk. In equity risk, you had a general charge 8% of market value, and then specific risk 4 to 8% depending on issuer. Foreign exchange, you had 8% of the net open position, and commodity risk, you had 15% of the net open position. Now let's delve into this further. Okay. For example, you had a net open FX position, net open position of GBP 100 million. Capital charge is 8%, which is 8% into 10, which is $0.8 million, and then holding 20 million in corporate bonds. For example, this 10 million GP arose of $20 million in corporate bonds rated triple B 3-year duration. For the specific risk, you multiplied 4% into 20, that's again zero point 0.8 million. General risk would be then the total. You'll just add 8 plus 8 and you will keep general risk duration is 1.6 into 20, which is 320. Okay, let's go over this example in more detail and in a more slower manner. A standardized approach, it was simplified approaches. You have a net open FX position, GBP $100 million. Capital is 8 million into 10, which is half $0.8 million dollars. And as we saw in the last slide, the equity position was always calculated as 8% into the net open positions. Equity risk, this is equity risk, net position into the 8, it is 800 million. But if you have a 20 million corporate bond rated 3 million 3-year duration, how would you calculate this? A specific risk is 4% into 20, which is $0.8 million, and then the general risk is 1.6 into the 20 million is 320. So 320 plus 1800, you will get this 121. Again, this general risk duration charge, these were given by the Basel committee. These charges were given by the Basel committee. So The pluses and the minuses are, it's very simple, easy to implement, good for simple thing, and but the benefit, the cons, the negative points are, okay, it does not, it just there's no, it does not reflect any diversification. Like you could have been holding on to a bond in a low risk jurisdiction just for the diversification purposes. Okay, you already have some high risk bond, that's why you're holding it. Capital may exceed because there's no just a fixed charge applied to it, so it does not relate to the actual movements and actual fluctuations of the capital. Capital may excess, be inaccurate, doesn't adapt to real time mix. It just, since you're applying a fixed time, so there's not real time movements and real time interest rate movement, it does not apply to them. Second, the approach was the internal models approach, IMA, and in this approach, the banks were given authority by the Basel. Okay, they can use their own methods, like the value at risk, which was not that accepted that time, but with supervisory approval. Supervisory approval, they had to take approval. Okay, bhai, first of all, the bank would see whether they're equipped enough to measure VAR, because VAR was not uh, very well understood and very well in widespread use. So they need to take approval. So in simple term, VAR is basically like the maximum loss you can have over a portfolio. And in this case, as we see in the next slide, the VAR is a 10 day, we take over a 10-day trading period, 99% probability of having a loss over a 10-day period. Whatever you calculate, you multiply by 3%. And in case of when your banks are supposed to back test it, okay, fine, are they, is it robust, is it that way actually how they are calculating. And if it's like, if they feel the risk is more, then they can even multiply by 4 or 5. 3 is the minimum standard that was required. So I will repeat, what is VAR? Simply stated, it's a very lengthy concept, but simply stated, it's the maximum loss you can have over a 10-day period with a probability of 99%. There are models that go around it, and how capital multiplier would be keeping 3% of the VAR. And in case you feel that 3% is not sufficient, you can keep 4 or 5% as well. So again, it's a very internal modern approach. Daily trading book is like, let's say it's $5 million, multiplied by 3. So 3 into 5, 15 million. If poor back testing will increase. It is a simple example. It's a very simple example I'm given because VAR has some other major implications as well. So internal modern approach, what was subject to regulatory approval. You had to seek approval of your central bank and Basel. You had to back test it. Okay, you should not on your own say, okay, this is my multiple is 3. It could be more. We have to back test and prove it. Stress testing. See in case of normal or stress situations, how does this work out to? And as I said, the VAR, it's a 99% confidence level, 10-day holding period, minimum 1 day, 1 year observation period. Means, okay, you had to at least see, okay, in the last 1 year, what is the maximum loss you had, and then back test it and apply the capital multiplier to it. Now, pros and cons. First of all, it requires actual risk exposure because your actual trading book you have, encourages better risk management because you know you'll be accountable for what you're doing. So you'll be taking care of your risk. Then can reduce capital for diversified books. And in case you have multiple positions, and in case you take counter positions, so because you run VAR models, it factors into account the fact is that, okay, your risk is naturally diversified. Cons, the points which don't go in favor, required strong model validation. All this require a lot of robotics, lot of, and hence a bank needs to have the required ecosystem in place. High implementation and compliance costs, of course, because it requires a lot of systems in place. There's an implementation cost associated, and since you need to get it verified from your central bank and from Basel committees, there's a compliance cost. Risk of model manipulation if not supervised well. Any model is prone to human error or could be deliberate or otherwise, and hence it is subject to those errors. Now, comparing both standardized approach and internal modern approach for measurement of these market risks, you can see, since standardized approach just a small number applied to it, so it's low in complexity, low capital sensitivity, because it's just a small percentage applied to it. It's just not, there's no introduction of any market variable, there's no introduction of any anything that varies as per the market. So there's no capital does not go up and down and fluctuate a lot, no approval required. VAR, you had to take central bank approval and all. Not then fixed confidence level. See, there's no per se VAR to it, so there's no need of a confidence level. You need implied holding period. Like in VAR, you have a 99% confidence interval over 10-day period. There's no applying and higher capital amount because because you're applying a fixed charge to it. So there's a high probability you keep a higher capital amount to it. On the other hand, the internal modern approach, it's complex, it's sensitive to capital because your VAR could change depending on how your trading has gone. Approval is required. Then mandatory variable confidence level. Yes, we have to, as your trading book matures and you undergo various stresses. So the trading confidence level, like a 99%, but 99% of $100 million book is different from 99% of 200 or $500. 10-day holding period we have spoken about earlier, potentially lower capital because it's realistic, it's based on real time events. So yes, of course, compared to standardized approach will give a lower capital and a standardized and a more realistic value of the capital. Now, my I think my second last slide is about the Basel One, the pros and the cons of Basel One itself. First of all, before that there were no unified standards for bank. Now they begin unified standards came, and banks had to follow unified standards instead of just be going whatever they wished for and however they wished for. It's simple to implement. Majority of Basel One is relatively simple compared to the subsequent standards that came, and not much calculation involved. Prevent undercapitalization. Unlike banks that existed that time, which kept capital based on whatever their wishes or whims were, it at least, if not overcapitalized, at least prevent undercapitalization. Cons, the negative point again, the risk weights that were given, like OECD countries, 100% for risk-weighted asset corporates, 20% to various the risk weights that were given, 0%, 20% arbitrary. If you're giving 100% to a corporate client, then you're not differentiating between the risk level of those clients. If your company could be a high 7 plus could be a company on a Moody scale, and you give it 100% weight, even 2 rating on Moody scale could be a company, and you're giving it 100% risk weighted scale. So it did not differentiate between the credit risk of the companies. Ignore market and operational risk. Yes, of course, we have mentioned earlier, it primarily focused on Basel One, and based on some subsequent events, it had some amendments in 1996. And lastly, regulatory arbitrage. It gave loopholes because it allowed banks, okay, you want to use VAR, you want to use a fixed charge, and in internal, you want to use the internal modern approach, standard modern approach, you want to use how you want to calculate your certainty equivalent amount for the market risk. It also gave the two methods. So accordingly, because it applied, because it gave the exposure, like for example, if you were to in 1996, it gave the original exposure method, and it gave the or current exposure method. So it gives the choices. So regulatory arbitrage, companies applied what they felt were necessary. So this was the first of the lecture series. I will so next time I'll get Basel 2 as well, and that will be more interesting. And so hope to please subscribe my channel and give me some questions which I can, if you want me to answer. Thank you. Thanks a lot.